what I was going to talk about was an introduction to algorithmic trading models. And when I started to think about what I was going to say, I started to realize that maybe it's best just to make it as simple as possible, like give you enough of the buzzwords and the thoughts of what you have to learn more. I would say that this will probably be of some real value to someone who is starting out, starting to think about it. You cannot be a quant or a practicing quant or know anything about quantitative algorithmic trading unless you can code or you appreciate software development and you understand what it is and it isn't. You must also be able to follow the market. So all I'm going to do is just tell you that. You don't really have to know the mathematics of it. I would say it's probably better if you did, but that's something that you can probably not do. Again, if there's any questions or comments, if you'd like to challenge me later in jiu-jitsu, just please raise your hand or you can just scream out. There is no protocol at all. I just hope that everyone is comfortable. I know these guys that have the coats between them, they look pretty good. Okay, so I found some cartoons. I'm a big fan of cartoons because they kind of give you a sense of what this field is all about. These are my parents right here. I don't know if you know them, but anybody know where that comes from, by the way? Star Trek, thank you. I'm not the oldest person in the room, thank you. Yeah, so that was actually from the pilot. I don't know if like people know that. I was alive when the pilot, but I don't remember the pilot.
Without William Shatner.
Huh?
Without.
That's right. And the captain was named who?
Pike.
Captain Pike.
Like, yeah.
Okay. Put him down for an extra t-shirt. Sorry. So a lot of things when, and I don't want to start exactly this way, but when you say algorithmic trading, you'll see that that's a specialized word for something, and you're going to see that. The titles, the names, the styles of trading are just as important as how that you trade. And you will see that. Like, for instance, I love this slide down here in the center. It says high frequency traders. That's probably not true anymore, but maybe the first high frequency traders, that was probably true. Okay. So this is just to give you, I think one of the great instances in time was the flash crash. I was on a trading desk and we all just panicked. I mean, maybe it's me because I was there when the credit crisis happened and I was there for the flash crash. It might all be my fault. So let's start here. I was asked just very quickly to talk about myself. I don't really like talking about myself unless you have at least 4 hours. So, no, I'm just kidding. I have gone to school way too much. A headhunter told me you have more degrees than a thermometer. I always remember that. But in terms of the experience, it's important. I was in Hong Kong. I was the head of IT and analytics for the credit group in Hong Kong and City. I was at Fortress Investment Group in New York for about 3 years as a desk strategist. And I was at Deutsche Bank's very famous credit prop desk, and then eventually went into algo trading in like the rate case. In between those times, I was a professor at like the University of Miami, which was known for its like mathematics and football at the time. Now it's only known for its mathematics. And now I am at Boston University. If you have any questions, comments, you want anything more, I have cards. You can also go through Fawcett, the gang from Quantopian. They're also in Boston. Anything I have, I'm willing to share. You can take me out of the classroom, but you can't take the classroom out. On a personal skills level, this is what it's all about. Computer programming, applied mathematics, mathematical finance. And for me, I always say to my students, so please correct me if I'm talking down to you, it's not really meant to be. If you stop learning, especially in trading, you're going to fall behind. Bottom line. Thank you for the nod again. I appreciate that. It is true. If you stop learning, you are now behind. Okay, very quickly, I want to tell you some of the goals of trading, some of the frameworks that you have to understand, what you have to do with high performance computing, which is not so important for you if you go down the Quantopian route. This presentation, by the way, will be distributed by FOSS in like the meetup site, so
we're going to put it on the blog too. It'll be on the blog.quantopian.com.
Okay, thank you. And I'll talk about like backtesting. At first I was going to do market microstructure, which is a fascinating topic, and once we get to that point, If you guys would be so kind to invite me again, I'll do a whole presentation on it, because that's just totally fascinating. That's where the real alpha is going to come in. And then questions, if they're hard, I don't know, and if they're easy, of course, I'll answer. Okay, the most important thing, let's just say, what is the most important goal of any trading strategy? And I'm not trying to be funny. Make money. Make money. Make lots of money. If you can't make lots of money, you're in the wrong business.
Incorrect. I'd say risk management.
I'm going to get to that. Note that there is a number one, and I'll tell you there is a number two. Okay, so, and that happens to be risk management. But it is to make money. Okay, if you cannot make money, you will not be on Wall Street. If you cannot make money, you will not pass go, and you will not collect the $200. I guarantee you. Because in the end, unfortunately, being on Wall Street in general is you're on the front lines of what I tell my students, you're on the front lines of capitalism. You are there to make money. You can be ugly, you can smell, you can do whatever you want, but if you make money, you're good, okay? And it's true. And then not to be even more simplistic, but when you go into a trade, you have to generate a trade, and you want to buy, or, I mean, you want to go long or short, and the trade essentially has a side of long or short. It has a security of some sort that you want to long or short. You have a certain quantity that you want to buy or sell, and you want to know the price that you're going to get it. In the end, that's pretty much it, okay? Very simplistic. There are a lot of other things, trust me, but in the end, that's what it's all about. As you enter into that trade, you want to make sure that if you're long or you bought something, that when you exit that trade, that you sell it at a price higher than you bought it. It sounds very simplistic, but it's not that much more than that. When you bargain, like my parents are from Iran, if you go to Iran or you're in a bazaar and you have to buy something, they expect you to haggle. If you don't haggle, they think there's something wrong with you. Americans don't like to haggle. Thank you. Okay? For people like myself. But the whole point is that trading is part of the human nature. The thing about exchanges, algo trading, whatever trading that you want to talk that's more mechanized, that's what it's all about. It's done on a level that's institutionalized by the exchange, by regulations, and so forth. Do not underestimate the power of, I have to make money, okay? I put a lot of these quotes on top. There's one that will come, and it says that a person that wants to be right is an amateur. A person that wants to make money is a professional. Okay? The point is, don't do this unless you want to make money, because that's what it's all about. Just as important from the crowd over here is to reduce risk management. If you do something such that you make a lot of money and you find out, well, all I really did was I took your $100 million, I flipped the coin, and guess what? I was right. So here's your $200 million. That's the riskiest trade. You should take the money away from that person because you just got lucky. You don't want people that are lucky. You want people that are good. Luck is better than being good, but luck is not better than being bad. I think I said that wrong. But the point I'm trying to make is, you do not want somebody that makes money by being lucky because they just happen to be lucky. That's not good. You need something that's sustainable. So when you think of risk from a quant perspective, risk to me means uncertainty. Constraints. I just want you to have a sense that the constraints of trading are the regulations of compliance, technology in general, I'm trying to go faster, and the accounting. A lot of times when you think that you have made money, the back office says, well, actually you didn't make money because of this, this, and this, and that. There are things that the back office, the accounting types will do. I don't want to get into the structure of how a desk is formed or organized within a company, but it's important that you realize that if you think you made X amount of dollars, the back office may actually think it's actually a different number. So you have to understand the accounting principles of the back office just as well. They're the number that really matters. Okay? Market microstructure. This is so fascinating, and I apologize because I'm just going to go very quickly. True algorithmic trading at a certain level where it's intraday, even high frequency, this is what it's all about. Okay? But I'm going to skip that and just tell you that the most important aspects are, if I were to trade something, can I get in and out of that position quickly? Liquidity. That means if you're trading something obscure that only 4 people in the world like actually trade, you may not be able to actually trade that or to get out of your position because the other 3 don't want to trade it. Then you're screwed. Okay? If you go with the larger cap Fortune 500, you're probably okay based upon the exchanges where they are traded. Okay? Information flow, very important. One of the great hypotheses of great economics is the efficient markets hypothesis. Does anybody know what that is? That basically says that as the information flows into the system, everybody knows that information at the same time, and therefore there are no free lunches, okay? That's not true. It's just not true. One of the old jokes are there's 2 economists that believe in the efficient markets principle, and there's a $20 bill on the ground and they're walking by it, and they go, oh, look, there's a $20 bill, and they just walk by it. They don't even pick it up. Why? Because it's not supposed to be there. It should have been picked up already. Okay? It is not true. It does not work. Information flow will change. If you're a smarter investor or you're in the know, I'm not talking about insider trading, I'm talking about people that are more in tune with what should happen in this market will know something. Therefore, they have an advantage. On the market making side, there's a thing called asymmetrical information flow, which means that some people that trade with you that you know are in the know, you're going to believe their orders in terms of price and the actual direction more than Joe Schmo, the retail investor that you don't even know who he is. Modeling that is incredibly fascinating. Okay? Price discovery and execution. Once I know that I want to go into a position, by the time I actually execute at that price that I thought, can I actually get that price? Market impact, slippage, very cool stuff, okay? Again, I'm skipping, okay? But trust me, and if you want some books on this, I will show you both. And transaction costs. If it costs you $4 to make a trade that you just bought on this one stock for $3 and it went to $3.05, you don't know what you're doing, okay? The point being is that look at the transaction fees. They eat away at your profits. They will be. I'm going fast this time. Okay, very quickly. This is very important. This is probably, to me, for my students, the most important thing. Before you can even think about backtesting, trading, you have to have what I call a view. I think the world is going to end tomorrow. That's my view. You may think I'm crazy, but it's possible. And you set up the trade such that if that view is correct, I made a lot of money. That's the most important thing, okay? What is your view? I think that Apple's going to go down. If you said that 4 years ago, people would have laughed at you. If you said that 6 months ago to a year, you're the smartest guy in the room. The point is have your view, and your view can come from a lot of sources. Maybe it's just a gut feeling. Maybe you just bought this Apple computer and go, this sucks, okay? And I don't know, but you have to have a view. If you don't have a view, you have no business being in this field. You have to have a view. The view is then articulated by financial instruments. If you believe something in the equity market like Apple, I think I'm going to buy some Apple stock. It's going up. No. I think there's a problem with the fact that, I think oil is going to do this. Futures and commodities. Your view. Well, I'm going to hedge my exposure to Brent, which is blah, 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 Brent oil by basically hedging the exposure with the currency. Therefore, I'll do a currency swap. Whatever it is, the view is the key. How you articulate that view is just a mere formality. And there's a lot of ways of doing that too. But in general, the view is your view. And if you have a view that you love, don't share it with anybody else. Because as soon as you know it and everybody else knows it, the view is of no value anymore. Okay? By the way, the one adage that I know for sure is that if everybody thinks that it's going to go up, it's going to go up. And if everybody thinks it's going to go down, it's going to go down. So if you want something to go up, get on the TV. We feel really strongly about this. This is the greatest company. The executive team is fantastic. If you looked at their earnings, they're projected to get blah, blah, blah. I'll buy. Of course, tell the people that you're buying. Why? Because you're already long it and you're just waiting for it to go up. So why not just go up? But until you make the trade, mum's the word. Okay? Now, you hear these like terms a lot, buy versus sell side. Okay? I have always worked on the buy side, except when I did algo trading, that was on the sell side, which is actually market. Even though that I was at Deutsche, well, I take that back. Even when I was at Citigroup, he was actually on the sell side. I just did a lot more analytics work than trading. Buy side and sell side. Sell side, they make markets. Goldman Sachs, blah, blah, blah. Deutsche Bank, JP Morgan, Merrill Lynch. Okay, they make the markets. How do they make their money? By order flow. People trade with them. We're going to talk about that. Buy side says, well, we're a hedge fund. One of our biggest investors is the California pensions, you know, and our job is to take their $361 billion and make it more. Okay, we don't want to make a market. We want that assets that we have to actually grow. It's a different premise. Exchanges, there are so many that I can't even keep up with them anymore. They're consolidating as we speak. I hear that there's a poker game and a dice game in the back alley after this talk. I'm sure that they have some kind of market too, right? And their mother has it with the use of technology. It has gone through the roof. Okay? In the old days, there was New York Stock Exchange and there was the American Stock Exchange. Anybody as old as Sam like me that can remember?
NYMEX.
Where?
NYMEX.
Oh yeah, NYMEX, yeah. And like there was just a handful. Now it's everybody and their mother. Okay, and they are consolidating, so there'll be something, whatever. Order types, very important. When you place an order and an order becomes a trade, that trade becomes a position. The position is inside of a portfolio, blah, blah, blah. You have to think about how that order is going to be articulated. I want that price or I don't want it. Fill or kill. Okay, the point is, market, I want it now. I don't care what the price is. Limit. I want that price, but I want to buy, but only if it hits that price. These are the things that you have to know. And there's hundreds of order types. Before you can actually seriously talk about how to trade, you've actually got to start to sit down and say to yourself, how am I going to make what I want happen? That's the implementation side. Okay? Anybody scared now? Anybody want to give me their life savings and I'll make it more? Okay, this is a very important slide. Let's go through, can we do the stuff on the right first, if you don't mind? One of the most important things that you're going to have to learn is about time frames. How many of you have a 401k? Yeah. How many of you do like what I do? I look at it once a quarter and that's it. That's about it. The point is, I can't take it out. I just want it to be in certain sectors or maybe the actual index. Maybe I'll do a little bit with emerging markets, but that's it. Why? Because I don't really need the money now. Maybe I'll get close to the thing, but that's not funny, baby.
Well, you and I are right on the same age.
I'm 28 now. But I'm a big liar. But the whole point is the amount of time that you want this trade to exist is just as important as anything. If you have to do quantitative trading for 401k investing, it's not worth it. You're not going to play around with it that much. Okay? You want to go with something on the right called a fundamental view. You know, that's what you do. But I want to come to this. Just as important is the short-term investor, someone that holds a position maybe days, weeks, at the most months. A lot of hedge funds, institutional investors, prop desks. Their job is to say, by the end of the quarter, when we have to make our numbers known to the general public, to their investors, whoever it is, they have to say, we were up this quarter. They're, by definition, thinking in a quarterly cycle. Okay? Some of them hold something for only a day, but in general, it's days and weeks and so forth. Intraday is when it gets a lot more interesting, and I would say between the short term and the intraday, these are the people that start thinking in terms of algorithmic trading, quantitative finance in general. These are the people that hold a position for seconds and minutes and hours. Note that as you make a trade that's taking a few, that you're going to hold for only a few minutes, it's going to eat away your profits in terms of fees, okay? Some people at the high frequency end, which is really the utopian of all that probably is going to come with the computer revolution in trading. But I just want you to understand that the time frame is quintessentially one of the most important aspects of what you have to understand. The style of your trading, the amount of effort that you want to put forth will be dictated by how hard you want to work and what your time frames are. Five years ago, it was very hard for intraday traders and high-frequency traders to really compete against the investment banks. Okay? They had the infrastructure, they had the intellectual capital, they could basically do like what they wanted. Then some hotshots from MIT and all of the great schools started doing high-frequency trading, and they showed that there is a different paradigm. Okay? And hear all the stories about it now and so forth. One of the most important things is to understand about the style of trading. Fundamental views are analysts that work at investment banks that cover a certain sector or a certain company, and they'll come out with buy. Okay? They always have a figure like this. Sell, hold, neutral, whatever it is. The point is, in theory, those are analysts that are basically judging, and trust me, they're not all right all the time. Because for every one that you find that says buy, there's always two that say sell, and then you find, oh, now we changed to sell, this guy went to buy. There's no consensus. If you find one that you like and has a good track record, stick with it, okay? And that person will not be right 100% of the time, okay? Number two is the quantitative. That's people that would use a Quantopian backtesting engine and say, I have a rule. When this happens and this happens, I'm going to buy. As soon as this happens, I'm going to sell that and recover my position. That's a rule. Do you believe in that rule? Let's go to Quantopian, take a look at their 10 years of data, and find out if statistically that would have worked or not. If it did, you go, aha, I got something. Well, what's the Sharpe ratio? What is the Sharpe ratio? It's the amount of excess return per unit of risk. Is it like worth it? Well, the Sharpe ratio is 3.4. What's the time frame? The last 9 years. I like it. Sounds good. The point being, it's a rule, okay? And if you know people that are computer geeks, of which I think that I am one, I go back way too far. I started in Fortran, and then C, and then C++. Yes, I said Fortran. I go back that far. That's the way that my mind thinks. I like rule-based, quantitative-based. Algorithmic trading, quantitative trading is perfect for that. Statistical arbitrage, which you know, perfect for that. Okay, statistical like trading. That is quantitative, just by definition. And then something that, you know, they have hundreds of books in like your bookstore under investing. You know, Charlie Smith's Guide to Being Rich by the Time You're 25. He's got this formula to do this. Well, you know, if it's that good, why is he selling his book? You know, the whole point is that there's a lot of charting techniques. If you put on the academic hat, charting is considered voodoo science. Like, what the hell is that? It's based on charts. In reality, it's fantastic. Why? Because the computer needs to build constructs of certain things that are going to represent whatever. A trend, a moving average. A trending that should be on the buy. Well, the moving average on the short term has now crossed over the long term. The point being is that when you view this technical trading from a computer construct, it's fantastic. But you got to believe in your charting techniques, and you have to feel that this is exactly the one that's going to represent what I need. And in the end, it's still going to be probabilistic. It's pretty good most of the time. Well, how many times? 51%. Well, that's not good enough. We need it to be 90% of the time. The point being, it's like probablys are not really good enough. We need hard numbers based upon backtesting results. Okay? Does that make sense? I feel like a preacher. Okay. Now, rule-based strategies, I can't remember what I put. Oh, yeah. In general, your assets, you either just go long and short, and you have to come up with what's called a trading signal based upon whatever voodoo model that you have, and voodoo is considered a good thing because I wouldn't share it if you believe in it and you ended to show it. It says buy. You should buy. The rule says it. Well, do you believe in that rule? Well, you better not just say, well, I thought of the rule this morning, and which it looks good and it worked today. No, you got to go back in time. You got to build something. Execution traders, you see on the high frequency stuff, well, not so much, of course. Sorry. I'll just say on the algorithmic trading, their job for a long time, and they still do a lot of this, their job is to either accumulate or to liquidate large positions by trying to get the best price possible. So if I were to come out and tell Takashi, I have 100 million shares to get rid of. Do you want it? No. But as soon as he knows, and he tells him, or it gets advertised that I'm selling that much, the price is going to go down crazy. So people try to stealthily try to sell off their thing. Well, here's 100 for you, and 200,000 for you, here's 50,000. Before that you know, you're in dark pools, you're trying to execute a large liquidation or a large accumulation to get the best price for it. Very important. Okay, that's like the first generation algo trading, intraday, tipped value type trading. No question about it. Still very important. Yes, sir.
What would you say is a large transaction for something like
It depends upon the cycle.
Google or Apple?
I mean, Google and Apple are so liquid, it's something that large, and you should also say to yourself, if it were me as like a retail investor, I'm sure that most people say, who the hell is it? If PIMCO does it, if Renaissance does it, then people are like, what's going on? You know, that's that asymmetrical information theory. That's who's doing it and what's the size of it. And in general, you'll have probes out there like bots trying to figure out who's trading what, and then they'll come to the answer and say, somebody's dumping a lot of this. What's going on? I don't know. Well, that's not a good answer. You're showing something. Let me study it and get back to you. Then you go to the bathroom and go, what's going on?
So is the identity of the originator of the order public?
What?
Is the identity of the originator of the orders public?
It depends upon the exchange. Now, it essentially is. Buy side, but at the speed that things happen, by the time you analyze it and you know it, it's too late.
How is the originator known? How do you know NASDAQ? Who the order's coming from?
I don't know about NASDAQ. I do a lot of...
NYC, ARCA.
Yeah, in general, you can get like the last trade data, and you can actually find out, like if an order comes in, no. But if a execution, then yes.
So how?
You can look at, I'm trying to think of like, when I was, I did a lot of work with Broker Tech, and iSpeed, and we basically had it. We had a feed.
Not even the full open book will give you that. You can't track it back.
What?
You can't track it back.
You sure?
You could change, yeah, not in.
Okay.
Almost every venue has dictated they offer, regardless of what asset class. If it's fairly liquid, like the equities and futures and options tick data much faster. Spot FX is also good, but if you're trying to do something like liquid CES, you're not going to get the same kind of tick sizes as liquid FX. It's hard with market microstructure because ticks get published at different rates based on the venue. But in terms of equities, the 4 major exchanges and the 41 ECNs and the 40 ECNs, they publish ticks at a pretty consistent rate. But by the time you see that tick, unless you have the lowest latency feed handler, those few milliseconds it takes for you to get that into your strategy, get-go, Citadel, a lot of people have already gamed it, already traded it, and they're done. Slippage has already happened. Thank you.
Buy-side strategies is like fun. This is like, I have a view, and now I'm going to articulate that within something that says, now this is the actual trading. Nothing works anywhere. I said 45 minutes, right? This is very important, is the fact that you can use leverage. Okay? You can control more than the value of money that you have. Okay? One of the great ones are options and also futures. We won't talk about that too much, but I would like to talk about This, et cetera, is long and long and long. The uncertainties, okay? Market risk, okay? Model risk. Is my model that I'm using in this quantitative algo to price something actually valid? I overheard him talking about model validation. You know, it's not very sexy, I think is the word that you use. It's boring stuff, but you know what? It's very important, okay? Operational risk, especially on the algo trading, is that you've got to make sure that once you want to actually make that trade for a significant amount of money that you're plumbing, that everything within the infrastructure is actually going to work, okay? The day that Lehman Brothers, they actually went default on September 15th, which I believe was a Sunday. And then my algos which were doing 4,000 fills a day, which is nothing, went to 33,000. And the whole time I'm just like, and I was like, I don't smoke, but I better learn how to smoke too. Because I was scared. And then the point is, the real superstars, because I'm like, oh, it worked, of course. I knew that. It was the operational people, the people that kept the servers up, basically jerry-rigged everything to just be able to increase this load by essentially 10 times. A lot of great work. Position size, very important. Has anybody ever heard of the Kelly criteria? And Kelly criteria basically says size that trade based upon the odds or the advantage that you have, your personal alpha. If everybody knows something and has the same skill set, you have no advantage because you have the same skill. But if you have an advantage that you have against all that, and you know that it's going in your way because of that advantage, that's when you can make money. And Kelly criteria basically comes up with basically saying, use your alpha to size trades based upon the advantage that you have over everyone else. Very difficult math. It works. Everybody, I mean, they're not going to share it with you, but they will use it. It's fantastic. Okay? That'll be like at least 3 weeks of hard reading, and you go, what the hell is this? You can find, there's actually a very good book by a guy named Ralph Vince. Does anybody know that book? It's on asset allocation. He derives the Kelly criteria like in 4 chapters. Makes it very plausible. Yes, sir, Carl.
What about who was Bashir?
Who?
Who was Bashir?
I didn't know.
Was one of the founders of Mathematical Finance.
Who?
Who was Bashir? It's the first mathematical.
I don't understand the accent.
Who was Bashir?
Oh, Bashir, yeah. He wrote a PhD. I mean, he's a minor, insignificant person. But yes. This is a guy who wrote a PhD thesis in 1905, 7, something like that. He was the one who started the whole concept of a random walk, which is now very important. He did it wrong, actually, but it's and money management. Do you have a sense that the view, how it's articulated, and how much money, the sizing of the trade, the size is important. If you have an advantage because of your knowledge over everybody else, make it a bigger trade. In theory, you only have to make real money, you only got to be right more than you're wrong. Okay? You can even be wrong more than you're right as long as you bet big on the ones that you were wrong and bet small on the ones that you were right. I mean, I'm
Sell side.
sorry guys. The point I'm just trying to make is you got to be right more than you're wrong for the same side. But the caveat is you can be wrong more than you're right as long as when you're right, you bet a lot more to accommodate when you're wrong. In theory, computers, though they are fallible at times, the important thing is that they actually don't scream as much, they don't ask for days off. The point being is it scales better, and I think the quality of the trade based upon the rules is what's important. That's where a Quantopian and the implementation of it is tantamount to you being able to become a world-class trader without working 24/7, because you've got the algos like working for you. Okay? I'm trying to save time. So in the end, if you were to build something, I have built, and I still build, and I like to code, you need a data feed. Any price, volume, prints, whatever it is. It could be on the order book level. It could just be from the last executed prices and so forth. We need to generate a signal. It's a rule-based generation of trades. That's your view. How is the view that you had being articulated within a construct that the computer can recognize with all of the data? Based upon backtest results. As you're trading, the backtest should be updated, okay? Because statistically, you have more data now, okay? 3, place the trade via a order management system, and you must need to verify the trade status. Anything that I build always had a big red button, cancel all, or stop. Okay, if all fails, stop, okay? You've got to have a catch rate. It's a lot more sophisticated now. We have got to be able to say, why didn't that work? Did I miss something, or whatever? The point is, have your fail-safes too. Okay, when I wrote okay there, that's contingency planning. What if your server dies? What if the data feed tick doesn't work? What if the exchange went down and you're still waiting on the status of the trade? So maybe I better find out that, what's the status of my trade? That's part of my algorithm. Did it execute or not? I don't know. I mean, it should have, but the API, it doesn't work anymore. The point is contingency planning, right? In the end, the code for it working is that much, and all the other stuff makes it this much. I could do it in lines of code. And then in the end, you add to the blotter and you monitor your P&L and risk. Okay. I stole this image years ago for presentations, and it's just basically giving you a sense that in the end, what you really have to do is you have to work within some kind of server farm. You've got to be able to get the feed. You've got to analyze it in an algo engine type environment, and eventually you have to have a execution of an order. The important thing over here, I think, is latency sources, okay? When you're at the high frequency intraday trading, speed is everything, okay? A few microseconds or milliseconds is everything. You're out of the game, okay? Speed does matter. And the sources of speed being taken away from you by far is basically the speed of light. It's not infinite, okay? So if you have an exchange and you have a server farm there and you can co-locate your algos there, you can save room. And you can save context switching, network I/O, and jitter. Does anybody know how jitter is actually defined? Jitter?
Standard deviation given certain time frames, measured in different ways, but
Yeah. Jitter, the key is that if you have a certain amount of latency, but the latency is erratic, that's like jitter. You have certain latency. Java real-time, C++, I'm sure there's a plethora of people in this room that are much better than me in trying to articulate what's the fastest way to do things. I'm a C++ guy, but I know that C is faster than C++. I just don't want to code in C. I'd rather code in Java or C#. And I know we're going to go to Python. Co-location. If you can get there on the execution queue at a certain level of price before someone else, you're making real money there. All right, I'll go through these last 3 or 4 very quickly. It's been 42 minutes, and I'll finish on time. I just want you to have a sense. Oh, this is a true story in terms of the quote. During the credit crisis, we had a standard deviation come up on a stat arb that I wrote, and the guy says, it's at 7. This is fantastic. We're going to make a lot of money. And I told him that 7 is impossible. He goes, what? It's at 7. I said, because 7 on a daily standard deviation is, I think I figured out it was like a 1 in 10 million year event. In other words, it was garbage. Okay, the model was garbage. The point being, always recognize that even though it's statistically sound and something comes back, what if you have an event that you didn't account for? What if you have a time series that you did in sample that just doesn't make sense? The point is your model's not going to pick it up. Okay? So always be your own advocate of your own program. Do not have an ego. You're only as good as your next trade. You're only as good as your next golf swing in golf. Don't get too high, don't get too low. Okay, the bottom line is the day to gloat is the day that you come home with your bonus check. That's the day to gloat. Okay, but the point is, it's not easy. And when that guy said 7, I said, do not trade. He goes, no, it's 7. Then I had to quickly figure it out. It was like 1 in, I think it was 10 million years or something. And I said, so what? And then I had to explain that to him. It means the model doesn't work. Okay? There's nothing wrong. There's no shame in not knowing. The shame comes from not knowing and being stubborn enough to not admit that you don't know what you're doing. That's the shame. And when you're a trader, you cost the firm thousands, millions of dollars. That's the problem. Okay, in the end, any goal of any backtesting is to come up with the performance parameters. Whatever that you're doing, the parameters that went into, well, I'm going to use a 28-day moving average, blah, blah, blah. Well, why not 29? Maybe it's 32. Could have been 45, but somebody told me it should be 15. The point is, there's a number that's exactly right. How much time that you want to invest in it, there's a lot of really cool ways of doing it. Genetic programming being one, okay? Entry and exit signals. Just as important to know when to get into a trade is when to get out of that trade, okay? Has it made as much money as it's going to make? No. Keep it on. I don't know. Well, that's a bad answer. The point is, as much as you think about when to get into a trade, you should think as much about how to get out of that trade when I'm in the trade. A penny saved is a penny earned. Does anyone know who said that? Huh? Benjamin Franklin. Quick question is, when you do back testing, what you're fundamentally saying is that what's occurred in the past is a good reflection on what occurs in the future. Okay? That's fundamentally just what you're saying. So if you truly believe in the trading horizon that I'm going to do, because I'm going to keep this trade off the next 3 to 6 months, that the last 4 years is better than the last 15 years, so be it. But it's not a good answer. But it's the best answer I can give. This is where that I want to tell you. All of this stuff is art as much as it is like science. It's very important that you realize that everybody in this room with the same tools like a Quantopian may come up with totally different things that they believe for the same view. And they can prove it in multiple ways. Yes, sir?
So, to add to that point, right, when you're doing back testing, right, how do you know you've crossed the line from back testing into curve fit?
Okay, very good question. One of the great things that everybody talks about is Sharpe ratio. Okay, Sharpe ratio is a wonderful construct that says that we believe that the excess return over the amount of risk is such as this. If it's not at least 2 something, this is my rule of thumb, I don't want to talk about it. Okay, it's got to be solid. Top of it, in terms of the backtesting results, I want to know what is the average, what is the probability of a winning trade? If it's 60%, 70%, I feel good. If the ratio of how much I bet constant is such that the winning trade over a losing trade is still a positive number and it's appreciable, then I feel better too. Then the last one is, I just lost it. I had it in my head and I lost it.
Win-loss ratio.
Oh yeah, and like the win-loss ratio. I want to make sure that I'm constantly just making money. These are the performance parameters. Thank you, whoever said that. Oh, sorry.
He's owning this question.
Okay. So the point being is that these performance parameters. If you want a good book on this, I forgot the author's name. I will think of it and post it on the actual meetup. I should know it because I read it a lot. But these are parameters that you want. Again, it's more art than science. Again, you've got to feel good about it. And do not trade your retirement to get the kinks out of your system. You know, okay? That's not advice. You can use somebody else's retirement. Another very important thing is that once you build something in sample, which means for this, it's always good to test it against things that you didn't test your parameters for. Okay? Sometimes data is expensive. Thank God for the people at Quantopian that have spent tons of time and money to provide that data for you. Thank you very much. But if you didn't have that, you can do simulation, okay, which is almost as good. Some people don't like it, but I don't have a problem with it. And then you'll hear these terms like stress test What if the world were to come to an end tomorrow? If the world comes to the end tomorrow, I'm not going to be here. I'm sorry, guys. Okay, I got much better things to do. But in terms of a time series, let's look at some events that have occurred in the past where something extraordinary has come about. What would happen to my portfolio? What would happen to this trade? And then I always believe, did you guys like the ones that I did up there? I would never join a club that would take me as a member, Groucho Marx. Well, I have a new one. It said I would never vote for somebody that would run for office. I kind of like mine better than Groucho. But paper trade. That means start trading on the parameters that you set. Okay? Do not place actual orders. The best way to do it, I think Quantopian, you guys are going to have your own broker-dealer, right?
We're going to do paper trading first, then
Okay,
go
perfect.
from there.
The point is, always try to trade on the same environment that you did your back testing so that there's no operational inconsistency. Okay? Sometimes that's not even doable. Okay? When you're high frequency trading, it's almost impossible. But if you're just a day trader, no problem at all. Try to trade so that the systems are the same thing. And then the whole point of it is to actually go into a position, but not really, because you're doing paper trading, compute the P&L and the risk and blah, blah, blah. And the point is, you want to make sure that everything that you said and that you believe in is actually now working with live data. Okay? You cannot do an execution cost analysis because you can't model slippage, you can't model market impact. I think this is the next one. And then you start trading. Okay? Do not go to the Ferrari dealership on the first day you start trading. Watch your trades. You can go to the Ferrari dealership with me and Foss. We can go together. We can go together with you. You can get a red one for me, you can get a blue one for him, and a silver one for yourself. The most important thing here is you can now start to really look at execution cost analysis. When I thought the price was this, and that's when I decided to do this trade, I actually didn't get that pricing out of this price. Start to track that and see what's the actual problem. All right, that's it. Thank you very much. I will have cards if you want. If you don't want, that's fine too.
And please hang around, have more drinks, more to eat.